Thank you, listeners, for joining us today on Ask the Expert. My name is Rob Butler of Sprott Money Ltd, and we are very excited to have the pleasure of speaking with David Morgan this morning. David Morgan is a widely recognized analyst in the precious metals space, industry, and consults for hedge funds, high net worth investors, mining companies, depositories, and bullion dealers. He is the published author of Get the Skinny on Silver Investing and featured speaker in investment conferences in North America, Europe, and Asia. With this, I am pleased to welcome David Morgan this morning. Hi, David.
Hello, Rob. Nice to be here.
We have a number of questions that have been submitted by our clients and precious metals followers, so with your permission, I'd like to get right into it.
Let's go.
David, can you please explain why the silver to gold ratio is roughly 57 to 1 when historically it's closer to 15 to 1 and comes out of the ground at 9 to 1? And also, do you believe silver will ever go back to its historical average relative to gold?
Okay, let me answer the last part first. Yes, I'm on record in the early 2000s as saying I expect the ratio to narrow back to the 16 to 1, which is actually the classic ratio or the monetary ratio. That was an edict or a set ratio between gold and silver set by man, not by the market. And then why is it at 57 to 1 now when it comes out of the ground about 9 to 1, which are both correct? The market basically is where it is, and it doesn't really upset me that it's not in the 16 to 1. I think it's an opportunity. If you look at the last bull market, we have basically three major phases. You have undervalued, fair valued, and actually overvalued relative to paper money. That happened last time. Will it happen this time? I don't know. What I do know is we're still in the undervalued area right now for both gold and silver. If you look at what happened in silver in 1979, it started the year at about 6 and ended the year at 50, or the beginning of the next year. So year over year, 1 year, it went from about $6 to about $50, round numbers. So you're looking at about an 8-fold increase. And that took place in 1 year, and yet the bull market started basically in 1965. So I expect something similar this time. So for silver not to be at 16 to 1 or what I chose, I haven't stated it yet. I think 10 to 1 is where we're going to see it peak. And I could be wrong, but that's what I believe. And so to get there, we're going to see the acceleration during the final phase of the bull market when people that are asking Sprott Money these questions are already invested fully or well invested. And they'll be watching from the sidelines as the latecomers are jumping into the gold and silver markets hand over fist and can't get enough. And they'll just be watching this ratio close further and further and further. So I hope I'm clear. I expect it to happen. I expect it to happen in a brief period of time. And I don't expect to see that actually taking place probably for a couple, 3 more years. Now, you will still the gap narrow. In other words, it started at 80 to 1 or 57 to 1. Which means that silver has outperformed gold so far in this bull market, and I believe it will continue to do so. I think you have far more upside in silver, but nonetheless, it will take time. It's not going to happen in 2013, 14, probably 15 or 16 when you see it really accelerate relative to gold.
What's the general makeup of your portfolio in assets? Meaning, what's the percentage of physical gold, gold-related stocks, physical silver, silver-related stocks, etc.?
All of that's information that's in the Morgan report. Basically, when you buy the paid membership, and just the basic one is like $130 a year. I mean, it's $10 a month. Almost anyone that's a serious investor can easily afford that. We're talking about 2 cups of coffee a month. So in there is the top tiers, the mid tiers, the growth stocks, the speculations, and how to use the Morgan report. I go through that question about what's the correct ratio for how much gold to silver, how much physical relative to stocks, and all these are basically individual answers, but to generally outline it, excuse me, the older you are, the more you would favor gold over silver, and the older you are, the more you probably favor physical over equities. But it depends who you are. Again, I have guys that are in their 80s that are practically all physical. I have guys that are, older, and they have almost no metal, which I don't advocate, but that's their choice. So it boils down to the individual, but that's all basically spelled out in how to use the Morgan report and some of the information that you get when you're a subscriber. It would be much too difficult to go through it all, but I will say this, I am debt-free, and I think that's important, especially now because this market has been sideways for quite some time. So to go into debt to buy metals, I really still don't think it's a great idea to do that.
The gold silver bulls regularly report that the world is on the brink of a monetary system collapse. They report shortages in the gold and silver inventories, increased demand from Asia, bank runs in Europe, and many other factors that are supposed to be bullish for metals. Yet the price of gold and silver seem to be range-bound. With all these factors in favor of high gold and silver prices, what have been the price and why has it been stuck?
All right, well, I agree with almost everything you said other than the shortages. There really hasn't been any shortages, except for the bottom in 2008 during the financial crisis. There were shortages of retail products, shortages when you have a demand and it can't be met in any way, shape, or form. And that was true of like 100-ounce bars and silver rounds and silver eagles and that type of thing. And that didn't last very long. There was still plenty of silver relative to silver demand. It just wasn't in the correct form, and that was silver bullion, which is actually what I ended up buying at that bottom. Nonetheless, everything else he states is true, and there's two reasons for it. One, whenever you go parabolic like we did in April of last year, and you see the market move from 26 to 48 in a short, several weeks time frame, you're going to get, and especially since they're futures markets and they're paper trades for the most part, you're going to see a big oversupply. And until that oversupply is worked off, the market can't go up. Second thing that happens is the manipulation. Now, the main trend can't be manipulated. The main trend for gold and silver is up. But within that trend, when these characters come along and they sell like a year's worth of supply in less than one day, in other words, a few trades, obviously it's going to knock the price down. It's going to take time to repair that damage, and that has been done continually in the silver market. So that has an effect as well. And it's a psychological effect, more so than it would be a physical effect. The silver supply is still rather tightly held, and there's not a lot of people that are in the silver market physically that are giving up their positions. But nonetheless, since it's a futures market determined price, in other words, a paper-derived price, that's why you see discrepancies like we saw in 2008, where you had silver selling at less than $9 on paper, but if you wanted to buy it off of eBay or even a reputable dealer, you were paying about 30% premium. And so that's two markets, and that's what happens. And so I expect that could happen again. Nonetheless, that's the reason. Is it going higher? Yes. Is the overhead supply worked off? Answer, not yet, but it will be. I think we're going to see a higher price in probably the 35 to 40 by the end of this year. And then in 2013, I do expect nominal prices to go into new highs, meaning 50 as a nominal high. Inflation adjusted, you'd have to see like $135 silver to be a new high in real terms. Nonetheless, I expect to see in 2013 probably conservatively $65 an ounce by the end of the year. I'm going to give myself a whole year or so. Roughly a year and a quarter or so, what we already have left in this year. So the bull market, in my view, is still strongly intact, but this overhead supply is weakening. A lot of the shorts are out of their positions. The setup is pretty solid from here on. Normally we bottom in August. We'll see. I think the bottom is in on the metals.